Good morning. This is Larry Edelson from my Uncommon Wisdom video for Thursday, December 30th. First off, I hope you had a wonderful Christmas and, of course, a very healthy and happy New Year. And be safe this holiday weekend and enjoy the time with your family. I also hope, of course, that 2011 is one of your most profitable years ever, and indeed, I really think it will be, especially in these markets, which we have some very, very interesting developments and some cycles coming into play for 2011 that should make for some very, very profitable trending moves in many of the markets. Let's go first of all to gold, to this week's action. Interestingly, gold is, as expected, pretty much drifting sideways in here. Now, a lot of investors and traders expected gold and other commodities to tank this past Monday as a result of China raising interest rates for the second time since October. Now, that clearly hasn't happened, as gold is holding its own, and many other commodities, including oil, for example, have rallied quite strongly this week. And I do want to explain to you that simply raising interest rates does not mean that natural resource prices or many other tangible asset prices have to fall. Indeed, very often, depending on where we are in the economic cycle, very often rising interest rates signal rising asset prices. And you might ask yourself a very logical question: why is that? Well, the reason is, if the cost of money is going up, so likely is the price of tangible assets and natural resources, and in certain situations, even stock prices. For example, if you look back at the 1970s, we saw interest rates in the United States go from roughly 3-4% to 18% in 1980, and we saw gold go from $35 to $850. Okay, as interest rates began to decline, we also saw gold and many other commodity prices decline from 1980 on. So that was a direct one-to-one relationship then. Now, of course, in the 2000s, first decade of this year, we saw interest rates decline, and we saw a boom in natural resource prices. So we saw the opposite occur. We saw commodity prices rise while interest rates decline. My point being, you can't just assume that because interest rates rise, commodity prices are going to decline. That's a very, very old economic myth, purely a myth, and it depends a lot more on what's happening in terms of international capital flows, where we are in the broad long-term economic cycles, and many other forces. So bear in mind, my message here is, don't listen to anyone that says, oh, interest rates are going up, so that means the end of gold's bull market. Oh, interest rates are going up, so that means the end of natural resource bull markets. Interest rates are going up, that spells the end of a stock market rally. That is not at all true. And another one, interest rates are going up, so real estate prices must go down. That's not always true either. So I want you, if I have one message for you for 2011, it's this: do not accept as conventional wisdom any of the economic rules of thumb that you hear out in the media and by most financial analysts. It's simply dead wrong, and it's going to be very, very wrong for 2011. Now, back to this gold chart. I expect, because we're in year-end and light holiday trading, that gold is probably just going to go sideways for the next couple of days. I am still intermediate term, I should say short-term, bearish on gold. There is a chance that gold could pop up to a slight new record high in early January, but that's about it. For me to change my outlook on the short and very short intermediate term on gold, I would need to see gold break above 1450, say up to 1460, 1470, then pull back and hold the support level in here. Then I would say, okay, the short-term cycles have inverted and everything's back All signals are green on the upside for gold. I don't believe that's going to happen yet. I believe we're going to see a sideways action, maybe a little pop higher, but then a test of support at 1325 and possibly even down to 1250, maybe even a little bit lower come late January, early February. This should not come as a surprise to you, and it should not shake you out of any of your core gold positions. You use it to buy additional core gold holdings for the long term and gold mining shares for the long term. Now I want to take a look at the dollar index. The dollar index has also largely been going sideways for the last few days. We're stuck in a trading range here. Many are very bullish on the dollar. However, the dollar has hit the upper level of this resistance and is now fading back down. I doubt the dollar will do much over the next few days. However, in the new year, I wouldn't be surprised to see gold poke its head above resistance and move into the 82 to 84 level basis the dollar index. That would likely happen with more problems occurring with the European sovereign debt crisis as we head into early 2011. But do bear in mind, the dollar is really only gaining strength against the euro. In fact, it's at a record low in terms of the Swiss franc. It's falling almost continually against the Asian currencies. So when you look at the dollar index, because the euro is so heavily weighted in the dollar index, the action in the dollar index really belies what's happening to the dollar versus the euro, and not really what's happening to the dollar in terms of many other currencies. Overall, the dollar remains in a long-term, very steep bear market, which will probably not come to any kind of head in 2012. I do expect for the third and fourth quarters of 2011 we will see a panic move to the downside in the dollar. But the first quarter and second quarter for the dollar index will have a slight bias to the upside, but not much. Now I want to go on to the Dow Industrials. This I find a really fascinating chart. I've marked a couple other areas on here. These blue rectangles here indicate formations that are actually short-term bullish. I talked about them in a previous video update a couple of times. You'll see that each one was, even though it gave way to a decline, each rectangle was ultimately exceeded by new highs. We had the first one here, we had a second one here, we had a third one here where the market came back off. I told you back here that this was not a high formation, that even though we were seeing a pullback in the Dow, that we would likely see new highs, post-recovery highs, and indeed we did. We are now starting to see another type of flattened upward triangle rectangle formation over here, which indicates to me that there may be one more shot to the upside in the Dow Industrials. Interestingly, this red line here, this red dashed line here, is a cyclically generated trend line that I've drawn in for you. And if the Dow were to rally up to this level in the next couple of weeks, it would be coming into the 11,885 level, which is precisely the annual bullish buy signal that I wrote about in my Uncommon Wisdom of a few weeks ago, where I introduced my year-end signals for the first time ever. So there is a very decent chance right now that we'll get a further rally in the Dow into the end of the year, into the first week of January, up to around the 11,885 level. However, I am still expecting a sharp, surprising pullback in the Dow Industrials in January, heading into maybe even early February, with a real possibility that we could break sharply to the downside to below 10 and even to 9,000. Any big downside move that occurs in the Dow Industrials in the first quarter of 2011 will be followed by a sharp rally into the spring. So you want to be on the lookout for buying opportunities in the early part of the first quarter of 2011 in stocks in general, but even more specifically and more aggressively in natural resource stocks. Till next week, again, please have a very healthy and happy New Year, and be safe on the roads this weekend. This is Larry.